So should you buy the dip in the bank stocks? Joining us now is Barclays senior analyst Jason Goldberg and Hennessy Funds portfolio manager David Ellison. David, what did we hear from the bank CEOs this week that spooked investors so much?
Well, I think we generally heard that sort of the basic fundamentals, whether it be margins, whether it be loan growth, whether it be spreads, lending spreads, or expenses, are all in flux, and there's a risk that they could turn more negative next year, which would obviously put pressure on earnings. And I think you see a lot of the analysts out there responding to that and lowering estimates or pushing out numbers a little bit into 24 versus 23. So I think the issue is the longer this goes on, the more this is going to be a grind, and the more we're going to have to battle the risk of credit, the risk of lower margins because of what's happened to rates and the economy. So we'll see what happens. But a lot of the basic fundamentals are now in flux to the downside, not the upside.
So Jason, as these earnings estimates come down, do you see buying opportunities?
As we think about the course, of next year, we do. I mean, we're entering, David used the term in flux, which I agree with. But you're entering this period with strength. So in the third quarter, the companies we look at, so let's say the top 25 banks by market cap, posted record pre-provision net revenue. That figure should grow in the fourth quarter and actually grow into the first quarter. So you're entering a period of uncertainty with really strong pre-provision net revenues, strong capital, and we think you'll see positive operating leverage next year. So revenue growth should exceed expense growth. Something you hadn't really seen over the prior couple of years.
And it looks like a lot of the big ones, Bank of America, JP Morgan, Morgan Stanley, Goldman Sachs, and regionals as well, Jason, even with the worries about loan and credit growth?
I think you have to be a little bit more selective on the regionals. They are kind of overexposed to net interest income, which certainly benefited this year from higher interest rates. Will benefit early parts of next year, but, that benefit should fade looking out. And then as credit losses rise, one area we're kind of becoming particularly more concerned about is commercial real estate lending, where some of the regional banks tend to be bigger players. So that's probably a segment you want to be a little bit more cautious on because you don't have the same level of diversity in those franchises.
What about you, David? Are you picking up stocks in this environment, bank stocks, or what?
Not really. I think I agree with everything that Jason has just said. The struggle I have is that we're at the beginning of more earnings problems as opposed to, earnings tailwinds. And I think that's the issue. We have to fight through what's happened to rates, what's happened to potential credit, if it will happen. So I just think we're in this period now where you just have to be patient and wait for the cycle to play itself out. I'd love to have a recession now. I'd love to have high non-performers. I'd love to have a more wacky yield curve so that we could get better. And the problem is nothing has gone wrong yet. And I think Jason says, look, earnings are going to be fine. And I think everybody agrees with that. And that's the problem. Everything's fine. There's nothing wrong. So there's nothing to get better. If there's nothing to get better, why is the incremental guy going to buy financials right now? So I'm hoping for tougher times ahead so that we can have a good buying opportunity into, let's say, the middle to the end of this year and then really rip the following year.
Jason, how do you respond to that? Why would now be the time?
Yeah, I think, we're not making calls certainly in the month, more over the course of next year. But I think one thing to keep in mind is just where valuations are. If you look at kind of, PE multiples on, 2023 estimates, they're trading under 9 times, relative to the S&P 500. It's almost half.